All right, today we're digging into Clover Health's latest earnings report for the second quarter of 2025. And this one, well, it's a real head scratcher. On paper, it looked like a home run, but then you look at the stock, and it's like they struck out completely. So we're going to figure out exactly what happened.
Yeah, so this is the big mystery we need to solve, right? How on earth does a company come out, beat expectations, and then see its stock fall off a cliff? We're talking a 20% drop, just like that. The numbers looked good, the CEO sounded confident, and yet investors just bailed. Let's unpack why they hit that sell button so hard.
Okay, so first things first. Let's start with the good news. This is the story Clover wanted to tell, the part of the report that you'd think would have sent the stock soaring.
So, the revenue number, it was strong. I mean, really strong. They brought in $477.6 million when the street was only expecting about $468.3 million. That's a solid $9 million beat. It shows demand is there, no question.
And the bottom line? Same story. They posted a loss of 2 cents per share, but get this. Analysts were expecting a 3-cent loss, so they actually lost less money than predicted. You add it all up, and that's a beat on revenue and a beat on earnings. So far, so good, right?
And check this out. This number is huge. Their Medicare Advantage membership, which is a super critical growth metric for these guys, just exploded. We're talking up almost 32% from last year. That's not just good, that's them absolutely crushing the industry average and snatching up market share. And of course, management was loving it. The CEO, Andrew Toy, was basically saying, see, our model works. We can grow like crazy and stay profitable. The whole narrative was about confidence and execution. So you're probably asking the same thing I was. With all this fantastic news, where on earth did it all go wrong? Well, this is where the plot thickens, because hidden underneath all those great headline numbers was one single metric that just blew up the whole story. This is where things take a very, very sharp turn. Okay, before I show you the number, we need to talk about something called the benefits expense ratio, or just BER for short. For an insurance company like Clover, this metric is, well, it's pretty much everything. Think of it this way. For every dollar they bring in from premiums, the BER is how many cents go right back out the door to pay for doctor visits and hospital stays. So lower is always better. A rising BER, that's a massive red flag that your costs are spiraling out of control. And here it is. Just look at that jump. Last year, their BER was a pretty healthy 76.1%. This quarter, it shot up to 88.4%. That is a huge leap, over 12 full percentage points. It means their medical costs are just running away from them, way faster than their revenue is growing. And this was the first major crack in that perfect earnings story. But this slide right here, this was the nail in the coffin. It wasn't just that the last quarter's costs were bad. It's that management turned around and told Wall Street, hey, guess what? It's going to get even worse. They raised their cost forecast for the entire year. That's the signal that this isn't some one-off blip. It's a trend. And that, right there, was the trigger for the sell-off. Which brings us to how the market reacted. Because as any investor will tell you, the stock market is a forward-looking machine. What happened yesterday is history. What's going to happen tomorrow is what really counts. And the impact was just immediate and brutal. The stock closed at $2.85 on earnings day. The very next morning, once everyone had a chance to digest that new guidance, boom, it closed at $2.26. Do the math on that, and you're looking at a drop of over 20% in one day. And this wasn't just a few people selling. The trading volume was massive, more than 3 times the normal daily average. That's not a dip, that's a stampede for the exits. The verdict from the market was crystal clear. So, to put it all together, the market basically threw all that good news about growth right out the window. The revenue beat, the new members, didn't matter. All they saw was that flashing red light about future costs. The fear of what's coming down the road completely wiped out any good feelings about the past quarter. Okay, so we've got this picture of a company that's growing like a weed but can't control its costs. So what's next? Let's put on our analyst hats and make our call on the stock. All right, looking ahead, here are the 4 things you absolutely need to keep an eye on. First and foremost, that BER number. It has to stop going up, period. We need to see it stabilize, or even better, start coming down.
Second, there's this big 4-star payment rating they're hoping for in 2026. We need to see that confirmed. Third, their big tech promise, the Clover Assistant. Does it actually work? Does it lower costs? The jury's still out and we need more proof. And lastly, they've got to get their hands around some of their other big expenses, like prescription drugs.
So, after weighing all of that, what's our official rating? We're calling this a market perform. Look, that growth story is legit. You just can't ignore a 30% pop in membership. But, and it's a huge but, the cost problem creates a ton of risk. Until they can prove, with numbers, that they can get that BER under control, we think the stock is just going to tread water. It'll probably move with the overall market, but it's not going to be a breakout winner. The growth is great, but the costs are putting a hard ceiling on the stock's potential.
And as always, we have to say it, this is not financial advice. We're breaking this down for informational purposes only, so please do your own homework.